stay invested. Don't worry about your accounts. Don't look at your accounts. Don't read the news, right? All of this is common information that advisors love to tell clients because the bottom line is it's true. At the end of the day, having more stock could be very beneficial to your retirement portfolio. This is in very much contrary to the belief that you need to be more conservative as you retire. Now, this came about in a handful of conversations I've had with clients, not just this past year, but just over the last handful of years I've been doing this, with the understanding that most questions or most ideas or thoughts that I get from clients, they say, as I'm getting ready to retire, I think I should probably shift, right? I should shift my investment allocation so that I can become more conservative. I need to preserve what I have built up already so that I can maintain my lifestyle in retirement. Now, this of course is true. You need to maintain your current lifestyle in retirement, but the big falsehood around having too much conservative portfolio dollars means you're not going to have enough for the end of your life. So this is a big misnomer, is that most clients don't understand that you want to open up and extend more your portfolio into growth assets. Now, what are growth assets? Growth assets are stocks, equities, could be in the area around real estate-like investments, right? Those are all growth assets. And when you think about fixed income, bond-like investments, you're thinking of shorter term, you're thinking of CDs, the idea of going down to the bank, getting a 12-month CD that's paying you 1.25% right now. So in this current environment, especially in this year's current environment, that's not going to outpace the 6% inflation, right? So we really need to be cognizant of the idea of getting the right portfolio allocation, because time in, time out, I see clients either when they're starting out with us or when they've been away for a while and they're coming back, the idea of I need to be less risky as I'm in retirement, or you're listening to the news, you're reading different articles that are just telling the falsehoods of you need to be safer. And of course it's true, you need to be safe enough in retirement, but think about your retirement horizon. If you retire at age 60, 65, right, the average age for life in the US is about 83 for a male and a little bit longer for females, right? So that could be upwards of 20 years plus just on average, not even talking if you have longevity in your family, if you're healthy, if you're taking care of yourself, right? You can be 90s all the way up to the hundreds. And so that's a long time for you to sit in a very conservative allocation. And it's interesting enough when you actually look at the research, and because this is our industry and our field, there's a lot of research around this. But there's been a handful of research papers that come out and discuss the idea of actually increasing your equity or growth asset exposure into retirement. And again, it may sound counterintuitive because you're thinking, well, I don't want to take on that level of risk because then I could lose out on retirement dollars. Well, it's actually the opposite. We need to take on more risks so that your portfolio can continue to grow, so that if you get to age 90, 95, you have assets still in your portfolio to be able to live off of in those years. Otherwise, if your portfolio is not making enough, right, it could lose out to inflation, it could lose out to current spending habits, it could be a handful of different things that could lessen your lifestyle because of the wrong portfolio allocation. So one thing to think about and consider is the idea of risk. So when you think about risk, you're thinking about the amount of the dollars that you're putting out into the market, whether you're investing it through stock market or real estate style of investment, right? And you should be compensated for that level of risk. Now, what determines that compensation is up to each individual, right? Whether it's 6%, 10%, 3%, right? And the market will adjust because in the law of averages, everything kind of works out, right? So in that sense, you should always be rewarded for the amount of risk that you're taking. And so in retirement, as you're gearing up for retirement, you need to be able to take on a level of risk that will produce the level of return that you need to take money out, right? And we've talked about somewhere around the safe withdrawal rate being no longer 4%, but using a dynamic withdrawal rate, you can get upwards of 5 to 5.5%, barring taking into account some parameters that come around that. But the biggest thing to keep in mind is that even though you're taking on more risk in stocks and equities and growth-like investments, you still have the ability for your portfolio to grow more, right? And that helps create leverage for you later in life. So I want to kind of squash the idea and the notion that you just need to be really conservative in retirement. You don't. And a lot of what the media headlines will drive and what you'll read about is you need to limit your risk as much as possible, be as safe as possible so you don't lose that big nest egg that you've built up. When in reality, if you look at the data, you look at the history of the stock market, right? During recessions, during different periods of downturn, right, the market will recover in a certain amount of years. And so it's really focusing on and figuring out with us, using us as your advisors, the distribution strategy and what that would look like in the event of something happening. Right now, the odds of some kind of downturn happening are always going to change, and there's always going to be some kind of downturn, in the future. We don't know what it's going to look like or how big or for how long it's going to take place. However, we have portfolios that can withstand some of those things through, the allocation that you may have through fixed income or through some of the less risky style of investments, right? But really, the majority of what you have invested should be riskier because we really want you to be able to create lots of wealth, to grow your portfolio, to be able to not only sustain your lifestyle today, but also in the future, and potentially leave, an inheritance to those that you love. So if that's something that's been on your mind of, hey, I'm kind of feeling leery of where the market is, I don't know if I'm properly allocated, let us know, because this is one area that I think a lot of clients tend to misunderstand as to how we're invested, making sure that we have a strategy in place, not just for today, but for the future, because it's important for us to be able to generate that growth that we need, not just for, again, these years, but for years beyond. So really, really think about what that means to you and how we're invested. If you're really conservative by nature, then you should lean on your advisor more, right? And you should stop looking at the headlines, because a lot of where the risk can affect you is really about looking at your account many times throughout the week, throughout the month, right? That'll generate what we call more volatility, right? The volatility is the movement of the investment either up or down, and it's the levels, the magnitude as to which it goes up and down. And volatility in that definition can be a lot higher if you're viewing your account multiple times a week, right? Because you're seeing it going up and down, you're seeing it, bouncing around, because it will. But that creates then the internal conflict of, well, I'm very scared, I'm very worried because I don't know, if this is going to end well for me. When in reality is, as long as we're patient and we stick to the plan and we're not just buying and selling investments willy-nilly, then we believe that it'll work out really well in the end. So keep that in mind, that, a lot of what we do say and preach about around, hey, make sure you don't look at your accounts every day, every, a couple times a week, even a couple times a month. That might just drive you crazy and drive you to do something that can negatively affect your plan. Meaning you're coming to us saying, hey, I don't want to invest this money. I'm really worried. I want to just go to cash. And in the meantime, your cash is getting eaten up by inflation. So that was kind of a segue into what we've seen a lot around the headlines, which is inflation is still really high. And having money invested in growth assets, in equity-like assets, can help protect against high inflation, right? Because again, these companies can generate pricing power in their industries. You're not going to be able to generate a return above inflation, at least in this current environment, right? If you're going to a bond, if you're going into a CD, yielding you something like 1.5%, 2%, right? You've already lost the game because inflation's already hitting you at 6% on all the costs that you have just to live. So again, this kind of comes back to the case that I was talking about, which is we want to make sure that we're properly allocated, because when we allocate money to growth-like investments, to equity-like investments, or just equities, it can help generate a better return to outpace inflation, whether it's today or in the near future, and help offset a lot of those negative yields or very low yields that we've seen in the short term. So it kind of helps in both ends, right? Making sure that you're properly allocated, meaning that you have a good exposure to equities, and then also staying in that exposure throughout your retirement, and perhaps even increasing your exposure to equity so that you can generate the level of return that you need to sustain retirement all the way into, say, your hundreds or your mid 90s, right? It's obviously going to depend on everyone. Everyone's got a different age that, we'll all leave this earth, but in the end, we want to make sure that we're planning for that 95 to age 100, because the worst case scenario would be you get to age 95 and you have no money. So we always want to be planning for that, and if it works out better one way or another, then great. So I hope this information has been helpful for you. If you do have questions around your investments or how you're invested, please let us know. We'd be happy to go through that with you. Make sure that you're feeling great about the direction and the long-term strategy that we have in place. If you like this video, hit that like button, hit that subscribe button. If you're not subscribed already, it really helps us out. And please share with your friends. We're really trying to grow the channel. If there's topics that you want us to talk about, let us know. As always, have a great day.